Avichi College of Arts and Science is a unit of AVM Rajeshwari Education Trust. It is a co-educational institution affiliated to the University of Madras. It commenced its curriculum in the year 2018 under the august leadership of Mr. A.V.M. K. Shanmugam sir. His motto is to equip students from nobody to somebody. Avichi College of Arts and Science offers undergraduate programs such as BCom General, BCom Accounting and Finance, BCom Bank Management, BCom Corporate Secretarial, BSc Visual Communication, BSc Computer Science, BCA, and BBA. With the support and guidance of our principal, we inculcate practical knowledge to students in our curriculum. Avichi College offers mentorship program to professional experts in their respective fields. During the first year of the BCom, the students of Avichi College of Arts and Science got the opportunity to be an intern at IIT Madras. Apart from curriculum, our students also actively involved in extracurricular activities like sports, NSS, RRC, Eco Club, and ED Cell, and Fine Arts Club.
So it's going to be for approximately 45 minutes that I'm going to be going through the slides. I don't intend making any of you experts in investment, but the very purpose of this session is to make sure that I end up creating basic awareness on the need to have financial security and how do you, again, looking at ways as to how you can create that financial security, and from financial security moving forward, how do you create wealth, how to build wealth, and in the process, understand the difference between savings and investments and what are the various avenues available for doing savings and investments. So it's going to be a very, very intense session for the next 45 minutes. I'm going to have to be quick because I have a number of slides to cover. So the questions will have to wait until end of my speech, and we'll have probably around 15-20 minutes to answer the questions. I'll try and answer as much as possible, and we'll take it from there. So let's jump into the slides straight. So as I mentioned, the objective of today's session is to create awareness on the need to have basic financial security. How do you create that security? And from there, how do you build your wealth? And what are the various avenues available for you to doing that? Next, please. The previous one. Yeah. Now, financial security, it's a very common term. I don't know how many of you have heard that. I'm sure most of you would have heard that. But simply put, it's a state where your income is more than your expenses on a regular basis. It's not that, on spurts, you make a lot of money and then you have expenses. So on a regular basis, on a day-to-day basis or month-on-month basis, you have income that is able to meet your expenses and also allows you to save a certain portion of that. And additionally, you also have enough savings to meet unexpected spend. We're all human beings. We live in a very uncertain world, and you can't always predict what's going to happen to you and your family members. And so it is prudent that you have certain sum available for you to meet such unexpected spend. It could be a health emergency, it could be a loss of job, it could be a lockdown like it's happening today. What financial security ensures is that you are able to cater to such unexpected eventualities. All of us are, again, normal human beings, and it can happen to any one of us. It can happen to many of us, as it's happening today. And the third aspect of financial security is that you are able to generate enough wealth to meet your future financial goals. That financial goals could be, upgrading your house, or sending your children for higher education, or retiring early, or doing something which is really, which you're passionate about, like traveling, or doing something completely different. So all of us, at some point or the other, we will have certain goals that we want to achieve, and the financial security will enable you to pursue those goals. When you have financial security, obviously you're going to have some peace of mind. There are always things that are going to take up your thinking on various aspects, but financial insecurity could be a very big stress, and it is a stress for a lot of people in the world today, whichever country you take. So there are a lot of people who struggle in managing the day-to-day affairs from a financial aspect. So when you have financial security, it's a lot of freedom. It frees up your mind to pursue other value-adding goals. So in summary, financial security is a very good thing to have. If someone can achieve financial security, that person moves on to the next level where that person can pursue other interesting objectives that they may have. Next, please. Now, how do you achieve financial security? As a beginner, most of you are very young people. You're studying and you're going to be, starting your careers in the very near future. So when that happens, towards achieving a financial security, you have to have some basic understanding, which is what is your financial position in terms of your assets, liabilities, what's going to be your income, what's going to be your expenditure. So it's sort of a budget that you create for yourself. It could be for an annual budget, it could be a quarterly budget, it could be 5-year budget, but without planning, you are setting up yourself for failure from that aspect. So somebody who doesn't worry about what's coming in, what's going out, is bound to fail in most circumstances. Some may be lucky, but most of us will fail if we don't know what's going to happen from a financial standpoint. So to start with, know your position and then move on to setting up short-term and long-term goals. Now, short-term goals, as we mentioned, unexpected exigencies. It could be a medical emergency. It could be a sudden loss of income because you lost your job, or it could be a health issue because of which you're not able to continue to work. So there could be a lot of things that result in unexpected spend. And moving from there, you have other things like people generally want to take annual vacation, travel to various places, and generally provide a good time to themselves and to the families. So it's another thing that you should start planning for as a short-term goal. Slightly medium-term to long-term goal is, previous one please, providing for your children's higher education. Now, education is a fundamental requirement in today's world. Very few make it big without a formal education. Most successful people have a good education behind them. Some may not have completed that, like Steve Jobs or Mark Zuckerberg, but it's something which provides a basic foundation for success. And like normal human beings, all of us want our children to do better than us in our lives, in their lives. So higher education is something which is going to be a certainty, and education is not cheap. It's getting more and more expensive. The better the college, the better the course, more the money. So you need to plan as to how you're going to provide the education that you aspire for your children and what your children aspire for themselves. And like everyone else, we want to have a roof over our head. It could be our ancestral property which you want to upgrade, or you want to buy a new home, and it's quite expensive in today's world. And finally, as mortal, normal human beings, we are all going to retire at some point in time. Nobody wants to work until death, unless you are an actor or some other artist. But generally speaking, people would like to retire from a regular 9-to-5 job and pursue other goals, or simply relax. All of this need money. You can't have any of this with peace of mind unless you plan for it in advance. So to achieve financial security, you have to have a clear awareness as to where you stand, what you need in the short term and medium term and long term, and how you go about it. Next one, please. So it's again, just a pictorial illustration of what are the various aspects of financial security: medical emergencies, house repairs, building a new home, providing for children's education, and having a good retired life. Next one, please. To achieve financial security, the fundamental thing is that you need to have some surplus funds. That surplus fund can be generated in two ways. One, you make more than what you spend, or you spend less than what you make. Now, if you're able to manage and maneuver your earnings, that you can spend as though there is no tomorrow. But most of us will have a limitation on that one. We know that our income is going to be a certain sum, plus or minus a few, dollars here and there. But our earnings is going to be generally a fixed sum, gradually growing. So what you need to do is, knowing your income levels, you need to make sure that a certain sum of that is always set aside towards your savings. So it's like paying yourself first. You, as a person who is struggling to make that money, you have to take care of yourself and your family. So keep a certain sum away every month or every quarter. And that, leads to the next point, which is keeping the sum in a secure place. You can keep the money in a locker box at home, in which case the money is actually generating negative income. As you know, there is a inflation aspect. The money today is more valuable today than it is tomorrow. So as costs keep increasing, you can buy less and less of things with the same amount of money. It's the time value of money, as we call it. So if you keep the money as it is at home in a safe box, that's not going to help you. So what we have to make sure is that the money works for you. The money can work in different ways. It can give you very high returns if you take very risky ventures, or it can give you moderate returns if you follow a safety route. Now, as a beginner, to start with, you have to make sure that you are set aside certain sum of money. And secondly, you also have to make sure that that money works for you and it's not put to too much risk. So you won't straight away start buying companies or going and investing in startups whose future is not certain. You're going to start with a bank deposit or a savings account or a fixed deposit in secure banks. You don't go into blade companies that are quite famous, that used to be famous in Tamil Nadu, which give you 2% per month or 30% per annum. Those are simply unrealistic and very, very risky. So you would start safely keeping your money in reliable banks who have been in business for a number of years and whose record is very, very good. So, most of you must be familiar with what's happening in the banking scene in India. Even a bank like Yes Bank, which has been in business for so many years, can run into difficulties because of mismanagement. So it's important that you safeguard your savings in such a way that you don't lose them. Thirdly, once you meet those short-term objectives in terms of having some good amount of savings, then you look at how to maximize that or how to build on that. That's where the building wealth comes in. Now, savings is one thing, but building wealth is much more than that. And we'll look at how we build wealth in the following slides. With all this, you don't stop. It's a constant way of living. You don't stop your planning in year 1 or year 5. At every time you will look at it, it could be annual, quarterly, some people do it every day, and then see what you need to do differently, whether you have met your goals. If you have met your goals, can we afford to do something more? Can I increase my earnings? Can I increase my wealth? So those are the things that you would do. But as a starter, you have to get your fundamentals right. You start from the beginning, you don't take too many risks. You start with very secure investments, then move on to bigger things once you understand how things work. Next one, please. So financial security in general is critical for everyone who lives in this world. There's no one, unless you're a sadhu or somebody who has given up, renounced everything in the world, financial security is a must-have. More than ever, individual financial security is critical today because our social structure is changing. We used to have a huge joint families. When one person doesn't work, the remaining people pull them along, carry them along, and support their families. It happens even today, but less and less so. So as an individual, you wouldn't want to depend on somebody else to take care of your living, to take care of your family. So it's important that you secure your financial future. And it's more important than ever today with what is happening in the world. Job security is not granted. My dad started with one company, worked with that company for almost 40 years and retired from that company. I've had 4 or 5 employers, and more people are aware that nothing is guaranteed when it comes to job. You may work in the best company, you may be very good, but when it comes to the crunch time, who knows who's going to go? So that's where financial security is a big support that you need to have. And specialized higher education is getting more and more expensive. So you want to give good education to your children, you better secure that in terms of good financial security. And a lot of companies do not have the pension schemes or pension plans. And I do not know the current scenario in India in terms of the government pension plans, but you can't continue to depend on that like people used to depend on them in the past. I think the government jobs still provide for pension, but a lot of private industries may not provide that. So it becomes important for you to make sure that when you retire, you have some regular income coming in, because you're used to a certain way of living and you wouldn't want to continue with that, if not improve on that. And finally, health and peace of mind largely depend on your financial security. I mean, it doesn't require any further emphasis. People who are well off have, at least from that perspective, they have peace of mind. Money is not a big worry for them. They may have other worries, but people who are not careful with their money, they have a lot of other worries in addition to the financial worry. The financial worry overtakes everything else, so they have to constantly struggle as to how they meet their expenses, how they take care of the family, how they provide for their children's education. So financial security is a critical thing to have, and there is no better time than to start early when you're still very young. Next one, please. I mentioned fast changing world, you can run quickly. Things are changing very fast. Yeah. What was taken for granted some years ago, it's changed. It doesn't exist anymore. And look at these companies. They didn't exist 25 years ago, but today they are some of the big companies. They have pushed a lot of other companies like GE or General Motors, Ford, ExxonMobil. Those companies have been relegated to the background. These are the companies that are on the forefront. What this also means that when things can change so fast, you're also going to be impacted, mostly positively, and sometimes it could be adversely as well. So it's important for us to prepare ourselves for the ever-changing, fast-changing future with financial security. Yeah, next one, please. Okay, so now let's get to the fundamentals. Now we have been talking about savings. Savings is simply the excess of your earnings over your consumption or spend. You make 4,000, you spend 3,000, you have a positive savings of 1,000. You earn 4,000, you spend 5,000, you are in debt of 1,000 rupees or dollars. So it's simply saving is the excess that you keep over your spend. You could spend less than what you earn, or you can earn more than what you spend. It depends on you, but it's easier to spend less than what you earn than earn more than what you spend, because earning is not always in our control, mostly. Next one, please. Okay, having seen savings, it's also important for us to understand the difference between savings and investment. Now, there is, these words are used loosely, very interchangeably, but there is a fundamental difference between savings and investments. Now, typically, savings is characterized by a low risk, low return. A bank deposit or a bank savings account is a low risk one, provided the bank is good. If you get into some rotten banks, that could also be a high risk one. Because you wanted to make a percentage or two more, you shouldn't choose the wrong banks. Generally speaking, bank savings accounts and deposits or post office savings are very low risk, but as a consequence, they also give you low returns. You can't depend on savings and FDs for all your savings. What it means is that if someone has, let's say, crores and crores of rupees, and if he puts everything in fixed deposits, that may be a very safe thing to do, but it may not always be the wisest thing to do, because that person has lost an opportunity to make the money work for him or her. So it's, how you make your money work for you is the critical thing. And that's where the investment comes into picture. Now you can keep the money in the bank, safe, secure, but very low income or low return. On the other hand, you can, once you achieve certain level of financial security, okay, I can afford to take a little bit of risk. Now let us see how else I can invest this money. And that's where the investment comes in, away from savings. Now, investment is committing the money to a fairly long-term or medium to long-term to an investment product with the goal of making higher income than a bank deposit with an enhanced level of risk. Now, there is a wide array of opportunities available. Not everything is high risk, not everything is super high risk. There are certain products which are slightly higher than a bank deposit, but they give you slightly higher returns too. There are certain things which are very high risk, but it can also give you a very high return if it succeeds. So the distinguishing factor between savings and investment is the level of risk and the level of return. Low risk, low return, high risk, and high return. Next one, please. So as you can see in this slide, I've demonstrated various aspects of investment. A cash and safe is a savings. It's a negative savings because the money is simply lying there, losing value every day, every month, every quarter. So cash and safe is a savings, but it's not working for you. A deposit in a bank is a saving. Definitely it works for you, but it works reasonably less efficiently and effectively. It's effective, but not very efficient. But it does not mean that you take out all the money from the bank deposits and put it somewhere else. You need to have certain secure investments or savings, and a fixed deposit is a very good instrument for that, as long as a bank is a good bank that you can depend on, a bank that has got a good history. Then moving from there, you got things like debentures. Debentures are basically instruments of debt issued by companies like Reliance and a lot of other companies. From time to time, companies need some short-term to medium-term funding. They don't always go to the market with share issues. So they issue debentures for 5-10 years. And these debentures are, they carry a certain level of interest attached to the debentures. And typically companies pay those debenture interest in priority over the dividends to shareholders. So again, a fairly common form of investment in India for risk-averse people. And but the return is again very moderate. Moving from there, you have the mutual funds. There are a number of mutual funds in India that have done well in the past. Some have not done so well in the recent past, but generally mutual funds in India have been very, very safe and secure, providing anything between 10 to 12% rate of return, and some even 20%. But things are changing. In the last 10 years, the returns have been phenomenally good, but the past is no guarantee for future. But mutual funds play a very important role for people looking at safe forms of investment. Then we move on to shares, the equities. There are thousands of companies that are public limited companies, which means their shares are available for public to buy through the stock markets. Now, shares are fairly risky if you don't know how to do them. Investing in shares is not everybody's game. People always think that share market is it's a gamble. Or some people say share market, you can double your money, triple your money. But that's not all true. In certain cases, you can double your money in a short period of time. In many cases, you can also lose your money completely. In majority of the cases, if you're careful, you can also make a decent return of anything between 8 to 20%, 30% every year. It all depends on what type of work you do in identifying the shares, who is advising you, how you are reacting to the market situation. Those things decide how you make the money work for you. It's not easy. It's not everybody's game. It's not there for doubling or tripling your money. You can lose your money, but at the same time, if you're careful, if you're smart, if you take professional help, you can also generate very good value. Real estate is fairly long-term, and if you really work it out in terms of rate of return, taking into account the time value of money, real estate today is not that great. If it grows at 5-6% per annum, it's really not a great investment because your inflation is 5-6% per annum. So your money stays where it is. It's not running for you. Gold, again, it's very, very safe because you can always sell it anytime you want. It's fairly liquid. Again, gold can be in the form of jewels or in the form of gold bars or gold bonds, but jewelries are less value adding than gold bonds and gold investment because you lose a lot of money in those, making charges and stuff like that. But gold is a very good form of investment. Today, it's fairly easy in India also to buy gold, gold bonds. Moving into more sophisticated things, art. Again, it's for very, very high net worth individuals who can decide, who can actually know what it means and invest in them. It's not for common people. You can start your own business. Again, very high risk, fair amount of risk with a very good possibility of making good money and also equally good possibility of losing everything. So not everybody is made up for entrepreneurship. But if you're somebody who knows the tricks of the trade, who got some family businesses, you can look at that as an avenue for investment. You can invest in cattle farms, or you can invest in a lot of startups that can, one day become very big companies. Zomato is a startup, or Uber was a startup, or is still a startup. So a lot of companies who start very small, but they have a brilliant idea that can really become successful one day. But again, it requires a lot of ear to the ground. You need to know what's happening, what that company is doing. And you need to have the ability to take that risk of losing it all, because for every startup that succeeds like crazy, there are thousands of them which perish without a whimper. So again, you need to be very, very careful. You need to look at the security angle, the liquidity angle. When I say liquidity, the ability to encash it when you need the money. So those things decide what sort of investments you want to get into. And your risk-taking ability. That's also very important. If you're somebody who is a sole earner, you got limited amount of money, your risk-taking ability should be moderate to low. If you got a lot of support system, your dad is well off, you got ancestral property, then your risk profile could be slightly higher. It could be even very high depending on where you come from. So, one is your need for safety, liquidity, and your risk-taking ability. These are the things that decide what you look at from an investment perspective. Next one, please. Now, when do you start your investment? I mean, it's never too early to start. You could have already started because you always get some money from your parents as your pocket money. You can save some money out of that, and you can already have a bank account. If you're, even if you're a minor, you can have a bank account today. So it's never too early to start. And as soon as you start earning, it's a given. You have to start saving. You can't say, I just started earning, so it's okay to blow up the money on, buying expensive things and, fancy things. So keep aside a certain sum of your money every month right from your first salary and make it a habit. Anything that you do over and over again for a certain number of times becomes a habit. And if you keep postponing, it's okay, this month I'll spend, next month I'll keep, that's not going to work. So the first thing that you should do is pay myself first. And paying myself means setting aside that money for my future and for my family's future. And that could be in the bank, it could be in the debentures, or it could be in the mutual funds, whatever it is that suits you. And the benefit of starting early is the impact of compounding. Being commerce students, I don't have to explain too much the aspect of compounding. It works phenomenally well. That your money earns more money year after year, and there is more money being earned on that more money. So rather than standalone savings of 1,000 rupees today and 10,000 rupees 2 years later, if you regularly keep saving, the interest keeps getting compounded and the effect is phenomenal. Now, if you have a financial target, which I think all of us must have, that target will keep on changing as you grow older because you keep improving in life. You could start earning more. Your aspirations could be higher. Your children may want something better. Your wife may want something better. So your target keeps on changing. It's a moving ghost pole, as we say. And if you have a fixed target at 25 and never change it, there's something wrong. But you have to start with the target and keep changing it. When I say change it for the better. So when you have a certain target, starting early would mean lesser amount to be set aside every month. The later you start, the more you have to set aside. So let's look at that in the next few slides. So again, a pictorial representation. Go ahead, please. Go ahead, please. Go ahead. Go ahead. Yeah. So, this table clearly explains to you what are the various avenues available to you and how the money can grow. A certain sum of money in 5 years, if it's cash in hand, in safe, it doesn't change. It gives you negative return. If it is savings to the bank, savings account of the bank, they pay anything between 3 to 4%. That gives you a limited amount of upside, but it's very safe and liquid. You don't need any professional help. If you're somebody who's just starting and you want to safeguard your earnings or savings, a bank deposit would be a good thing to do. But it doesn't have to be all in savings account. You can set aside some money towards fixed deposits. Fixed deposits can be from anything between 1 year to 2, 4, 3, 4, 5 years, and they typically pay you slightly higher return. So as you can see, 1 lakh becomes 1,21,000 in 5 years. If it's a savings account, the same money becomes 1,40,000 if it's a fixed deposit. But if it's with the post office savings, they give you slightly more. And gold, on an average, it gives you 6 to 7% in dollar terms. In rupee terms, it will be slightly more. Again, you can't keep investing only in gold because the price of gold, though it's been on the ascent for a very number of years, it can also go down. And the problem is, if you want to sell or if you have a need for money and the price is low, then you don't want to take a loss. So gold as an investment avenue can definitely occupy a portion of your investments, but not all of your investments. Debentures, I explained to you what it is. They can give you anything between 8 to 12%, and I have taken the highest percentages. So they give you definitely higher return, but they are slightly more risky. Companies may default on servicing the debentures. You may not get your money back if the company is bad. And debentures are also slightly liquid because you can sell them in the market. I think in the debt market, you can sell them. But again, debentures are for some people who can take a slightly higher risk and who have a long-term view. Mutual funds, fairly liquid. You can sell them on day 1, get the money back in day 3 or day 4. Very, very liquid. But again, it can be risky as well because not all the mutual funds do well all the time. It's a reflection of how the stock market behaves. So if the market is doing very well, you would tend to gain. If the market is suddenly low, then you tend to lose. So the timing when you want to sell is going to determine whether you made a profit or not. If the market is low, you tend to make less profit or even loss. If the market is high, you tend to make a very good profit. Equities in the stock market, very risky, but very, very liquid, very safe, absolutely legal. You don't have to depend on too many people, and it is all sitting at your home in front of your laptop. With a few clicks, you can do or undo what you've done. And if you choose the right companies, you can end up making anything between 20, 30, 40, 50%, provided you do the right thing. If you do the wrong thing, you could get that entire investment wiped out. There are so many companies which have been listed in the stock market that have gone bust. There are so many companies. Satyam is a good example. It almost went bust. Thanks to Tech Mahindra's takeover, they were able to the stockholders, shareholders recovered some money. But there are a lot of companies which go bust. The recent examples are, Anil Ambani's group companies. A lot of them have gone bust, and there's no way the shareholders are able to sell their shares unless they're willing to take a very big loss. So insurance, again, it's a very good instrument of saving, equity-linked insurance policies, which are basically part of it goes towards your insurance and the remaining part goes towards your savings. It's an attractive proposition, but the reality is, it's part towards insurance, the remaining part towards equities or mutual funds. And it's a very popular way of savings for a lot of people in India. And they're very safe, depending on the company that you choose, reasonably safe, and they give very good returns, moderate returns, I would say, but they're not very liquid because you are stuck with them for 5 to 10 years. But insurance is a must that everybody should consider. It could be a health insurance is a given. A life insurance, who knows what can happen to anybody. Okay, so life insurance is something that you guys should look at as a critical element of your financial planning. Currencies and commodities, very risky, not for the normal people. You need to have a lot of in-depth knowledge to trade in currencies and commodities. These are basically trade commodities or trade in currencies. You don't invest in currencies for long term because you can make some money provided you deal in big volumes, and you can't invest in big volumes. You basically take positions for a few days, for a week or so, and then try and make a profit or mostly losses. So a lot of people in commodities and currencies are people who dedicate themselves to trading in them and who spend their lifetime researching and understanding. It's not for the normal people. So don't take it as something which gives you a windfall. It's not so. Business, again, it depends on your position. It's very risky, very illiquid, but sometimes it can give you enormous returns. Startups, again, as I mentioned, very, very risky, and sometimes you can end up making good money. Most of the time, you don't know what's going to happen. Arts and real estate is very, very illiquid. More so in today's context, you don't have buyers for real estate. A lot of sellers are available, but there are no buyers. So there are a number of avenues available. I can't give you a formula as to this is the right thing to do, but it is for you as an individual to understand what is available. Instead of closing your eyes, I just want to go with the bank deposits, nothing else, because I don't understand anything else. There are so many things available for you to benefit from. So it's important for you to be aware of those things and then take some professional help if you need, if it can help you to maximize your wealth. Next one, please. So I was talking about starting early. As you can see in this chart, what I've given is for a given target of 25 lakhs in the first box. If you start at 25, you just need to set aside 36,000 every month. So in 25 years, that 36,000 per annum, 36,000 per annum, which is around 3,000 rupees per month, becomes 25 lakhs at a given rate of return. Whereas if you want to achieve the same 25 lakhs, starting from the year 35 as opposed to 25, you have to set aside 90,000 rupees every year. So 36,000 and 90,000, there's a huge difference, all because you started early and it's compounding. Now, if you look at the other side, if I start at 35, but if I keep aside 36,000 every year, that only gives you around 10 lakhs as opposed to 25 lakhs. So the compounding magic is real magic. It does work for you, and starting early obviously means bigger returns. So next one, please. So this is a pictorial representation of how the banks work. Banks take money from the depositors, they lend to third-party borrowers, it could be industry, and then they make some money in the process. Part of the money goes back to the depositors, and the bank ends up making some profit, paying the money to the shareholders as dividend and paying the money to the government as taxes. So very simple. Banks are not very complicated institutions. Next one, please. Mutual funds collect money from individuals like you and me, and they collectively deposit that money. Instead of people A, B, C going and investing in company A, B, C, the mutual fund acts as a clearinghouse. They receive money, they employ their skills, they employ their professionalism, and their knowledge, and they choose the right investment options, and they are able to generate better return. And they are more secure because they are professional fund managers. They are regulated by SEBI, which means they have certain do's and don'ts, and hence they are seen as reasonably safe avenues for investment. A lot of Indians save in mutual funds through what is called SAPs, systematic investment plans. Set aside every month, set aside a certain sum of money and keep buying units, and that keeps growing. Next one, please. Insurance, again, insurance companies, how they collect small sums of premium from number of people. They have to invest that money to generate returns. So they go again to stock market, debentures, banks, buying government securities, partly in real estate as well. So they generate enough money to be able to service the policyholders in the event of an impact, like it could be a death or it could be an accident. So that's how the insurance companies operate. They collect money from you, deploy the money, generate some income, and they service the policyholders as the event arises. Next one, please. Now, it's a very short time. Understanding investment avenues takes a lot of time. It takes sometimes lifetime. And what all I tried is to give you some awareness. I didn't try to make you experts. Impossible, because I don't consider myself an expert on everything when it comes to financial investments. But as long as you become aware and start working towards improving that awareness and building your knowledge base, and then start trying it out, then you are doing the right thing. Then taking a very simplistic approach that I don't know anything, so I'm just going to stick to bank deposits. Now, stock exchanges, they are again very, very regulated entities. That's where all the companies that go public list their shares. It's a place where people can actually buy and sell stocks. And typically, if you sell or buy on day 1, by day 3, you either get paid or you have to settle the money. It's called a T+2. Typically, when you buy, you pay the money immediately. The next day, when you sell, you get the money on the 3rd day or 4th day. So that's how it works. And it's always through online brokers. You can't go and stand in the stock market and say, give me this many shares. It's not possible. All the shares are basically in dematerialized form. They call them DMAT, dematerialized. In the past, they used to be in paper form, not anymore. All the shares are in DMAT forms, excepting certain legacy holders who have not dematted. The new shares will have to be in dematted form. And there is a bank account which you need to maintain, linked to the broker account. And that's how you fund your account, or you get the money when you sell shares. When you're in the stock exchange, the critical thing is identifying the right stocks. And then, you also have to think, what is my risk-taking ability? Am I going short term or long term? So all these things will decide what type of investments you make in the stock market. It's an interesting avenue, challenging avenue. It's not impossible for beginners to pick up, but it's not for novices. You just can't get in the market and say, I'm going to double my money. Impossible, unless you are super lucky. Commodities trading, again, it's for specialist people. There are commodity exchanges in India. I think 3 or 4 of them are there. Multi-commodity exchange and a lot of other, 3, 4 other exchanges. But again, it's not for beginners. You have to understand how the markets work. So start with, mutual funds, equities, and then understand more and more of the market mechanism. Then look at commodities. If some of you may be very, very tech savvy, very savvy about the market, you can do it. I'm not giving it as a rule for everybody, but if you're a beginner, be careful with commodities and take some professional help. Even for stock market, it doesn't harm you to start with some professional help. Next one, please. So there are a lot of other, things that you hear, like a rate of return. How do I, what's the rate of return? That's the money that you make. The rate of return is a percentage of income that you make. Your rate of return should typically be higher than the rate of inflation. If the inflation is 5%, if your investment gives you 4%, you're actually losing money. So make sure that your rate of return is generally above the inflation rate. Insurance, understand how it works. Stock exchanges, how do they work? There is so much available in the internet today. There are so many videos in YouTube from where you can learn how these things work. What's a demat account? Who should I approach to open a demat account? What's a mutual fund? What is a SIP? What is liquidity? And what is allocation of portfolio? Allocation of portfolio is basically how much of my investment goes towards various components. It could be bank deposits, investment, mutual funds, stocks, gold, real estate, and some risky investments. So you can have a basket of things. You can't put all eggs in one basket, as I say. Don't overexpose yourself to any one particular thing. And that's going to be a disaster if that fails. If it succeeds, that's fine. But if it fails, you lose it all. And how do you choose equity? Read, talk to professional people, understand, then get better at it. Mutual funds versus direct equity. For beginners, I would say mutual fund is a good instrument. Once you understand, get into direct equity. Don't straight away jump into direct equity, or don't confine yourself to mutual funds. You can do both. Blade companies, very popular in those days, they used to give 12%, 3%, 10%, all those companies. Thankfully, that menace is reduced a lot. EMU forms, another racket, it's almost gone now. We don't know what is next, but those are not there anymore. Next one, please. Again, Sensex, it's a indication of how the market is performing. It's a simple calculation of what's the value of companies that are part of the index, and every day they give the Sensex and Nifty indexes. The higher the index, the better the market is doing. At least the companies that are in the index. It does not mean the market as a whole is doing. There could be a lot of stocks that are still losing when the index goes up. So Sensex, Nifty, again, there is so much material available in the internet for you to understand these things. And as you start understanding, talk to professionals to learn more and more about it. And assets under management, the mutual funds, they have all the money and they are collectively called assets under management. As we speak today, or some years ago, it was around 25 lakh crores that the mutual funds had from the people. The turnover of BSE on a daily basis is something like 1.5 lakh to 2 lakh crores. Same as the NSE. BSE is Bombay Stock Exchange, NSE is National Stock Exchange. And the market cap runs into trillions of dollars. So if you understand it, it's fairly straightforward. But for a lot of people, it's all Latin and Greek. But understanding is not very difficult, especially if you're a graduate in accounting or commerce, people like you. Next one, please. So who can help? You have to help yourself to start with. Start young, aim big, try and explore. Talk to people in your circle, talk to experts. They don't always cost money. You may be having a cousin, uncle, friend's father, somebody who knows it, generally very well. So talk to them and understand how it works. Start with a low risk and then graduate to moderate and high risk. Start with mutual funds, systematic investment plans. Once you gain confidence in the basic, go to the next level, and on and on. That way, in a few years' time, you will become as good as many other people. You may not become an expert, but you'll become an expert in managing your own finances. Now, I personally can tell you that because I decided that I was going to retire when I'm 55. When I became 55, I was making phenomenally good sum of money, but I said, I am retiring because money can keep coming and there is no end to it. I have enough financial security. I have educated my children. I am reasonably well off. I want to retire and pursue what I want to do, which is predominantly traveling. I love traveling. I spend a lot of time and money on traveling because that's what I enjoy doing. I also spend equal amount of time advising companies on a regular basis. So on the one hand, I still continue to make some money, but I am able to spend a lot of money in pursuing my passion. All that because I started early. I understood early on what financial security meant. I was lucky to get into good companies to work for that paid me handsomely, and I was able to save. Not everybody is going to be, there are a lot of people luckier than me, a lot of people not so lucky, but everybody has got his or her own calling. Whatever it is, you have to start as early as possible and start working towards creating your own financial security. For somebody, it could be 20 crores, for somebody, it could be 2 crores. But each one of us know our plan. And so know your plan and work accordingly.
How can I start investing with a little money?
Right. The little money is a very very generic term. The little money could be 10 rupees, 20 rupees for someone. Little money could be 5,000, 10,000 for someone else. But whatever is the money, there are avenues available today for very small amounts to be invested in the banks in the form of savings account. If you want to get into investments, there is no minimum limit for investing in shares. You can buy one share of a company using your online broker. So it is not necessary that you have to have a floor or a level of minimum level of a lakh or two to start investing. I started, of course, 30 years ago, 35 years ago, my initial investment was 4,000 rupees. I bought, based on advice given by one of my colleagues, I went and bought a share, and to my life, the first buy itself was phenomenally profitable that I got hooked onto it. But you don't have to worry about some amount being too little. The fundamental thing is, am I able to generate some surplus? So if it's a very small amount, let's say 100 rupees, 500 rupees every month, wait for a quarter, then invest using SIP every quarter, or wait for every 6 months, invest 7,000, 10,000 in the equity market. It all depends on your own background, your risk-taking ability, but there is no amount that is considered too little.
Thank you, sir. The next question, how to invest in share market? Is it safe for the small investors?
Right. How to invest in the stock market? Yeah, you just need to have the fundamental mechanism, which is having an account with an online broker. It could be HDFC, ICICI Bank. There are so many banks that have online brokerage services, and there are also other third parties like ShareCon and Carvey. A lot of guys are offering online brokerage accounts. There are some like I think Zerodha or some company in India which actually provides online broking services for no brokerage. So you just need to explore, understand how I can open an online brokerage account. That's the first thing. And then start funding your bank account linked to the brokerage account. It could be as little as 1,000 rupees. No amount is too small. Instead of doing every day, do it every month or do every quarter, but do it. And if you are very, very, let's say, I don't want to use the word scared, but if you're hesitant to do it on your own, talk to somebody in your neighborhood, in your college, in your mentorship. Talk to people and understand, what do I do? How do I do it? And how do I safeguard my money and at the same time generate some wealth? So you shouldn't get into the stock market with the idea of doubling or tripling your money in 20 days. That's not possible generally. But if you want to have a long-term perspective, you need to start looking at opening an online brokerage account. Talk to the right people who can guide you through it. Internet is the biggest guide today. Okay, it teaches you almost everything in fairly rudimentary fashion. So, take the use of, make use of Google.
Thank you, sir. The next question,
Yeah.
as a beginner, how much time is required to read the stock market before I could invest?
There are two approaches. One is you can decide I want to invest when I become an expert, or you can start, okay, I don't mind losing a couple of thousand rupees. Let me start learning and start doing. So the learning never stops. The best of the fund managers, portfolio managers lose money. So learning is a lifelong process. You're going to keep learning along the way. In the process, you're going to make some good money, you're going to lose some money. There are some people who lose good money and make some money. It all depends on what sort of approach you take, what sort of work you do, how much risk you take, and who is advising you, and what is the resources that you're using. So you shouldn't wait for 2 years. I want to become an expert and understand stock market before I start investing. Hey, it's a very good way to understand things by doing it rather than listening to somebody else telling you. So start doing it, but not with $1 million. Start with a small amount. I don't mind losing that money. Let me just go and buy some shares of, let's say, great companies like HDFC Insurance or HDFC Bank, HDFC AMC. There are so many good companies, fundamentally very, very strong. Britannia, Asian Paints, Nestle, there are at least 100 companies that can give you, which are there with a very good pedigree, and they have been giving very good returns of at least 10 to 12% every year on a compounding basis. So start. Don't wait to become an expert. You'll never become an expert. Nobody's an expert in the market. A lot of successful people are humbled because of failures. So
Thank you, sir. The next question. Where should I invest? In mutual funds or individual securities?
I think I touched upon this one. It all depends on your understanding, your knowledge, and your risk-taking ability. If you're somebody who's a beginner, start with a mutual fund or start with a combination of both, but start slow, start little. Don't overexpose yourself, because as you do it, you keep learning and then you become more and more comfortable. Then you can afford to take risky ventures. Okay, so there is no this or that. It's not a binary thing. You can do both. Nothing stops you from doing that. And I'm not saying that you should put all your money in equities or all your money is in mutual funds. If you're a beginner, mutual fund is a good way to start. If you're a beginner, partly in mutual funds, partly in very safe stocks is a good thing to do. If you're an expert, you would take some risks. Yeah, so it all depends on your background, your risk-taking ability, and the efforts that you make.
Thank you, sir. The next question. What are the points to be noted while reading the mutual funds prospectus?
Right. Mutual funds, okay. Though the past is no guarantee for the future, you have to look at the scheme objective, because there are different schemes having different objectives. That could be, liquid funds, there could be sectoral funds, there could be long-term funds, there could be balanced funds, there could be debt funds. So you need to understand what the focus of the fund is and whether that matches your expectations. Number two, look at the pedigree. Who does it belong to? Is it from some unknown new company, or it belongs to a pedigreed entity like Kotak or ICICI or HDFC Bank? That's another thing. Then look at the people behind it. Who are the fund managers? What is their experience? Have they done well in the past? And then decide what is the right fund for you. So I can't tell you in the next 2 minutes what all you should look at, but suffice to say that you need to look at the pedigree, the objective of the scheme, and how it matches your expectations, and then the people running the scheme, the fund managers as they call it.
Thank you, sir. The next question. Kindly suggest us the proportionate of investment in different avenues like bank deposits, shares, long-term bonds, etc.
Okay, again, nobody has been able to define a certain percentage. It's impossible to tell anybody this is how you should do it. It all depends on individuals' risk-taking ability and their expectations. But the biggest advice is do not overexpose to any one particular, particular scheme or particular avenue, because you never know what can go up and what can go down, because there are things that you can control, there are things that you can't control. And when it comes to stock market and investment in general, there are a number of factors that you can't control, like the COVID situation. Nobody expected that. Or it could be a border situation, or it could be a fraud in the organization. Those are things that you can't control. What you can control is, okay, am I exposing the right amounts in various things? So if you're a beginner, it should be skewed more towards safety than returns. If you're a moderate person, if you're going towards 10 years of experience, then you would expose more towards moderate risk. If you're an expert or you consider yourself an expert, then you would put more money towards high risk. But do not overexpose yourself to equity or mutual funds or bank deposits. You could probably have 20-30% distributed to equities to mutual funds, bank deposits, and other avenues like gold and real estate. But it's it's very, very person dependent. There is no magic formula.
Thank you, sir. The next question. Can I open?
One point.
Yes, sir.
I am already 10 minutes over time.
Okay,
I am
sir.
apologetic for that. My apologies. But what about, you know?
No issues, sir. If you're comfortable, you can take it. Take
Okay.
another 5 minutes also, sir. No
Fantastic.
problem.
Okay. Yeah.
So can I open a Demat account by myself, or I should approach an agent for opening an account?
You know, you only have to approach any of the brokers. They would come to your, you know, come to your place because they are always after business. You can approach any broker, or you can do it online yourself, provided you understand the nitty-gritties of it. Best thing would be go to approach a banker, tell them you want to do it, and they can help you with that. Typically, the private banks like HDFC, ICICI, they help people opening Demat accounts. I'm sure, you know, other banks like SBI, all those bankers should also be very, very open and encouraging to helping beginners like you to open a Demat account.
Thank you, sir. The next question: what kind of stock should I avoid investing or buying?
Again, very, very difficult question. There are plenty of stocks that one needs to avoid. Um, you know, companies that are not backed up by good management. Now, good management would obviously reflect in profitability of the company. Sometimes bad management can also cook up books and inflate the profits using unfair accounting practices. So when you're a beginner, please look at the standing of the company. You know, if you look at someone like Asian Paints, they've been in business for donkey's years, or Britannia, Nestle, or Procter and Gamble, or, you know, India Shaving. A lot of companies that have been in business for number of years, you can quickly make out by the name itself. If somebody mentions to you HDFC, you're not going to be wondering who is HDFC because because you see them every day in various aspects of life. They've been in business for 30, 40 years, and they've been consistently providing good returns, and they are subject to so many regulatory framework like the RBI and SEBI. But there are a lot of companies who, you know, who are not that genuine, who come into the market in the last 5, 7, 10 years, and they don't make a lot of disclosures. The management is not very transparent. So as you gain experience, you'll be able to identify what companies you should avoid. Okay, but sometimes there could be surprises. Nobody thought Yes Bank will collapse like that because Rana Kapoor was a well-respected individual. Company was in business for 25 years. But the moment you start hearing whispers, something is not to the right to the bank or with the company, then you start thinking. Okay, so again, I cannot give you a list of companies that you should avoid, but look at the, you know, track record of the companies, and that again you can learn by, you know, researching in the internet or talking to people. There are at least 100 companies in India today which are having a great track record, and those are the companies that you should research more to start with.
Thank you, sir. Next question. Nowadays, the banks are in trouble as we come across the S Bank crisis and other banks also. Is it safe to have deposits or money in a bank?
See, again, it's a very, very loaded question. I cannot guarantee that it's, you know, safe. At the same time, I cannot tell you, you know, all the banks are going to fold up. See, banking system is the backbone of any country. For the economy to run smoothly, banking is fundamental, without a doubt. Now, in 2008, when the subprime crisis hit the US economy and later the world economy, the banks were the most stressed, banks and insurance companies. So the governments typically step in to safeguard the banking system on an ongoing basis. So you have a lot of regulatory framework, checks and balances. Sometimes it fails, but it's not that it's always going to fail. And hence you have to have trust with the, you know, with the regulatory framework and the government, and also look at the history of the bank and keep your eyes and ears open as to what's happening with that bank, because there is so much coming through WhatsApp, Twitter, news, you know, the financial newspapers. You come to know what is going right and what is going wrong with companies, and that's where you can act swiftly. But again, don't overexpose yourself putting 20 crores in one bank as fixed deposit and be safe. It's not going to help. So you have to distribute your risk in various avenues and various entities. So banks are still safe. If the banks are not safe, and if people start believing that the banks are not safe, the economy will collapse. The government will ensure that the banks remain safe. And that's why RBI works overtime to support banks and also pull down banks that are not really doing good work.
Thank you, sir. Thank you for answering all our students' questions patiently. And now I would like to request our principal.
Professor, just 1 second. May I
Yes.
interpret?
Yes.
Mr. Shankar sir, only one explanation I would like to have.
Okay.
During this pandemic period, of course, there are several avenues people were looking for it, but one thing, the gold price.
Yeah.
That it has just gone up by 45% within just 100 days about. So what is the logic behind it? Why, when there is no demand, the shops are closed down,
Yeah.
people could not visit, but still the gold price, one of the investment avenue, keep increasing beyond the expectations.
So
Can you deliberate on that?
Yeah, that the gold price is not something which is decided by the Indian market alone. Yeah, it's a global commodity, and hence what is happening at a global level reflects in the gold price in India, just like oil price. Now, when there is a pandemic, the typical approach is to pull out of risky asset class and put the money in the time-tested investment avenue, which is gold. So a lot of big players, the gold price is not determined by how people buy gold in India in the gold jewelry shops. It's determined by very big players at the global level, the gold funds, hedge funds, and a lot of big money managers are the ones who decide how gold should move, or they are the ones who chase the big volumes of gold. And hence, when the COVID situation arose, a lot of risky assets were actually diluted and the money chased gold. And it is not only physical deliveries, as you say, people are not buying gold. People do forward contracts, and they just do contracts without actually taking delivery. So the propensity of that is that the price goes up or down rapidly because people are not actually taking delivery of tons and tons of gold. So it's a global situation where the money is chasing safe asset class, and gold is still considered to be a safe asset class. But I wouldn't say that it's going to keep going up like this forever. Okay, so at a particular point in time, the last 5 years, it went up like mad, went down, again it's going up. But I can't predict how it's going to happen tomorrow. But that's the reason it's a global factors, COVID forcing people to chase safer asset class.
Okay, anyway, thank you, sir. And there is another element in our SEBI called as the investor protection. To what extent our investors are being protected by the SEBI guidelines? So to what extent they can come for the rescue in case of difficulties?
So SEBI is predominantly focusing on the regulatory framework. They make sure that the companies have certain rules and regulations that they follow in the way they manage the corporate affairs. Like it could be the constitution of the board, it could be the appointment of directors, independent directors, and reporting and disclosures to the stock exchanges so that people know what's happening. This is at a overall level. Within that, if people have difficulties, for example, if company is not paying dividend, or if they suspect something, then you can always approach SEBI. There is a specific email address wherein you can raise your concerns, like an independent shareholder, that you have a concern. Can SEBI look into it? They'll look at it, provided it's a matter that requires SEBI's attention. They would definitely respond to you. Thirdly, if you want to be a whistleblower, that you know what is happening in a particular company, that some fraud is happening, you happen to know it, you can also bring it to the attention of SEBI. They will take action. So a lot of time, SEBI approaches the companies to provide clarification based on what is published in the newspapers or what is appearing in Twitter and stuff like that. So it's a two-way street. SEBI on its own has its rules and regulations and enforces them. SEBI also suo moto asks companies to explain or clarify things, and SEBI will also respond to individual queries.